Most business owners spend years building their holding company, but very few stop to ask a critical question. What happens when I die? And more importantly, how much of what I built goes towards my family versus a Canadian revenue agency and Revenue Quebec? Because without proper planning, the same dollars can be taxed twice. Hi, I'm Chris Kovalchuk, Portfolio Manager at Claret Asset Management. Today, I'm going to explain what happens when a business owner who holds a holding company passes away, where the double taxation trap comes from, and why planning early, especially with tools like an estate freeze, can make all the difference. Let's start with the core issue. Here's what actually happens when a business owner dies. When a business owner passes away, Canadian tax rules do not wait for the sale of the company's shares. Instead, the tax system pretends the holding company shares were sold at their fair market value immediately before death. This is what's called a deemed disposition. There's no real sale, no buyer, and no cash coming in. But for tax purposes, the government acts as if a sale has happened anyways. Why does it create a tax bill? Because the shares are assumed to have been sold, any increases in their value over time are treated as a capital gain. That capital gain is taxable, although there are small business tax advantages. As a result, the estate can owe significant capital gains, often hundreds of thousands or even millions of dollars, simply because the company's value grew during the owner's lifetime. But that's only the first layer of tax. This is where double taxation comes in. Within most holding companies, there are retained earnings, investments, portfolios, or other assets that have already been taxed at the corporate level. When those funds are eventually distributed to the estate or beneficiaries, they're typically paid out as dividends and taxed again. This is what people mean by double taxation on death. Same underlying value, two separate tax events. And without proper planning, there is very little control over the outcome. The first thing to consider is the spousal rollover. If the shares of a holding company are left to a surviving spouse, Canadian tax rules allow the shares to be transferred on a tax-deferred basis. In other words, capital gains tax triggered by death can be postponed, also known as the spousal rollover. But it's critical to understand what the spousal rollover does and doesn't do. It doesn't eliminate the tax. It simply pushes it into the future. When the second spouse eventually passes away, the tax bill comes due. At that point, it's often larger than expected because the holding company has continued to grow in value, which leads to the real planning question. What are we doing between the first death and second death? This is where pipeline planning comes in. A pipeline structure is a post-mortem strategy designed to reduce or even eliminate the second round of dividend tax that would otherwise apply when corporate assets are transferred after death. In simple terms, instead of taking money of a corporation as taxable dividends, the estate reorganizes the company so that value is received as a return of capital. The result is that the capital gains tax is settled at death, and that second layer of tax, triggered by paying dividends to wind down the corporation on those same dollars, is avoided. Pipeline planning isn't aggressive. It's well established and has been repeatedly reviewed by both the CRA and the courts. But it must be done correctly, and it must be done on time. This is not something you figure out later. It requires coordination between your executors, tax accountant, and your lawyer immediately after death. Now let's talk about something even better than post-mortem planning. Planning during your lifetime. One of the most powerful tools available to business owners and holding company shareholders is an estate freeze. An estate freeze essentially locks in today's value of your company in your hands while allowing for future growth to accrue to the next generation, often through a family trust. Why does this matter? Because capital gains tax is calculated on growth. By freezing today's value, you're effectively freezing the future tax bill, while any future upside happens outside your estate. That can mean lower taxes at death, easier estate administration, and greater flexibility for your family and succession planning. Estate freezes are most effective when done early, when valuations are lower and planning options are wider. Waiting until a health scare or a sale is imminent drastically reduces what can be done and increases risk. So if you own a holding company, here are 4 key takeaways. Death triggers tax on your holdings or capital assets, whether you're ready or not. Spousal rollovers buy time, but don't eliminate the problem. Pipeline planning can prevent double taxation. And estate freezes, done early, can change the entire outcome. Finally, if this is something you haven't reviewed recently or ever, it's worth having the conversation while you still have full control. The best estate planning is calm, intentional, and proactive, not rushed, reactive, and expensive. Thanks for watching. For more investment tips, please visit our website at claret.ca. And don't forget to subscribe.